Hi guys, Henry here from Investment for Expats. Just want to go over one of the blogs that writ a few weeks ago about investing in bonds. As we're seeing, as I was speaking, mid 2023, bond yields are actually quite attractive for the first time in 15 years. And I just want to talk over how to make use of this for your portfolio and how to make use of the kind of macro environment as interest rates start to get cut whilst we're near peak inflation, to make use of it for both the total return and for the yield curve inversion. Quickly go over what are bonds. I'll put a link in the description below because I think that'll give you more of an insight that you can go over in your leisure. But bonds basically just issued by governments, municipalities, or corporations to raise debt, and they give you back a fixed return, normally every 6 months. So what we're heading into now is what is called the yield curve. So what should happen is longer duration bonds should yield more than short duration bonds because you're taking more risk to go into the longer mature bond period. Now, what we have now is where it's inverted because we see more risk in the economies. You're actually getting paid more to keep in shorter duration bonds. So you're seeing kind of T-bills of less than a year off of over 5%. That shouldn't really happen. And it's offering less in the 10 years, you can see in this chart here. So what we're getting is in a lot of the governments, particularly more so the Fed than the ECB and BOE, is that they're going to be looking to cut rates sometime soon, potentially in 2024, when, I don't know, depends on a number of economic factors. Labour market is actually being one of the sticky factors that are stopping, probably cutting it sooner than later. So how to make use of this for your portfolio is where we're looking is to go straight into the midpoint of the belly of the curve. So if you're looking at 5 years, when that yield curve gets back to normal, what you'll be having is you still have some coupons from the bonds, particularly government bonds, so for example, treasuries, but also you'll have some significant yield in that as well. So if you're looking to go midterm, 2 to 5 years in the government bonds, that's where we think the key coupons yields are expected to be over the next year. We have talked as well about how to get kind of make most out of money markets and then kind of play it into the bond market in 2024 as it does pivot in bond funds to get total return. That's a bit more complicated. We'll go over that in another video, but for now, I hope you found that somewhat useful, that you can actually look to go into midterm bonds to get some coupons, particularly as the year ends and it starts to cut rates in that, and the yield curve comes back to somewhat normal levels. Thanks, guys. If you have any questions, I'll put a link in the description below, and you can have a read of the blog we've written at your own leisure.